Well, ladies and gentlemen, welcome back to Boss Economics World, the only show that takes the dismal science of economics and turns it into a full-blown tragicomedy. I'm your host, the one, the only, the guy who's been yelling at central bankers since before it was cool, yours truly, the boss economist. Today, we're diving headfirst into the latest Fed drama, because apparently, the world's most powerful central bank has decided to keep us all on the edge of our seats like a bad reality TV show. Buckle up, folks, because it's 2025, and the economic circus is in town. So, here's the deal, my financially curious friends. It's July 30th, 2025, and investors are out there parsing Jerome Powell's every word like he's the Oracle of Delphi, hoping for a crumb of a hint that the Federal Reserve might cut interest rates. Spoiler alert, they didn't. For the fifth meeting in a row, the Fed's like, nah, we're good, fam, rates are staying put. But oh, the drama. Will there be dissent? Will Powell crack under the pressure of Trump's Twitter tantrums, X-platform rants? Will the Fed's $2.5 billion building renovation become the next political piñata? Let's break it all down, from the surface-level clownery to the deep, dark economic underbelly, because here at Boss Economics World, we don't just report the news, we roast it. First up, let's talk about the Fed's favorite pastime, kicking the can down the road. The Federal Open Market Committee, FOMC, has decided, once again, to keep interest rates steady. Shocker, right? I mean, why make a decision when you can just sit back, sip your artisanal coffee, and wait for more data? It's like me saying, I'll decide what to have for dinner, after I've analyzed the nutritional content of every grain of rice in my pantry. But here's the kicker, folks. Investors are betting on a rate cut in September 2025, with a probability of over 60%, according to federal funds futures contracts. And why not? Back in June 2025, Fed officials themselves signaled 2 quarter-point rate cuts for the year. But here's the thing, Powell and his crew are playing it cooler than a polar bear in a snowstorm. We're data dependent, bro. We'll see what the jobs reports say, what inflation does, whether the housing market implodes, and maybe even what the stars foretell. Now, let's get real for a second. This data dependence excuse is starting to sound like a broken record. Sure, we get it, policymaking is hard, and the Fed doesn't want to jump the gun. But come on, Jerome. The economy's been sending signals louder than a foghorn at a silent retreat. Just look at the latest data, unemployment ticked up to 4.3% in June 2025, according to the Bureau of Labor Statistics, the highest since late 2021. Meanwhile, core PCE inflation, the Fed's favorite metric, is hovering at 2.6%, above their sacred 2% target but cooling from last year's highs. And let's not forget consumer spending, which grew at a measly 1.5% annualized rate in Q2 2025, per the Commerce Department. The economy's basically screaming, help me, I'm slowing down. But the Fed's like, we'll think about it, in September. Now, for my finance pros in the audience, let's dig a little deeper. The Fed's hesitation isn't just about data, it's about credibility. Remember 2021, when they called inflation transitory and then had to eat crow as prices soared? They're terrified of making another misstep. If they cut rates too soon and inflation spikes again, it's game over for their street cred. But if they wait too long and the labor market tanks, they'll be blamed for a recession. It's a classic central banker's dilemma, and Powell's playing it safe, hoping the data will magically align like stars in a rom-com. But wait, there's more. Not everyone at the Fed is sipping the wait-and-see Kool-Aid. Enter stage left, Fed Governor Christopher Waller and Vice Chair Michelle Bowman, the dynamic dissenting duo. These two are ready to cut rates now, and they're not afraid to say it. Waller's out here giving speeches about how the labor market is on the edge, warning that if the Fed doesn't act, we could see a rapid deterioration. And Bowman's nodding along, like, yeah, what he said. Now, if both of them dissent at this meeting, it'll be the first time since 1993 that two governors have voted against a policy decision. That's historic, folks. But here's the thing, dissent isn't just drama for drama's sake. It's a signal. The labor market is starting to look shakier than a Jenga tower in an earthquake. Just look at the numbers, job openings fell to 8.1 million in June 2025, the lowest since early 2021, according to the Job Openings and Labor Turnover Survey, JOLTS. And the quits rate, a measure of worker confidence, dropped to 2.1%, signaling that people are clinging to their jobs like life rafts. Meanwhile, long-term unemployment, those out of work for 27 weeks or more, jumped by 15% year over year, per the BLS. So, what's the Fed waiting for? A neon sign that says, recession ahead? Look, I get it, Waller and Bowman are the hawks turned doves here, and not everyone agrees. But when the labor market starts flashing warning signs, maybe it's time to stop navel-gazing and start acting. For my finance pros, think about it this way, the Fed's dual mandate is price stability and maximum employment. If they're so obsessed with inflation that they let the labor market crater, they're failing half their job. And for the rest of us? Well, a weaker labor market means fewer raises, fewer jobs, and more stress. Thanks, Fed. Oh, but we're not done yet, folks. Let's talk about the elephant in the room, or should I say, the tariff-happy former president in the room. Donald Trump's been screaming for rate cuts louder than a toddler in a candy store, and he's not stopping anytime soon. But that's not all. His August 1, 2025, deadline for trade deals is looming, and the Fed's got tariffs on the brain. Why? Because tariffs mess with inflation, and inflation messes with everything. Here's the deal, folks. Tariffs are basically taxes on imports, which means higher prices for goods. And higher prices mean, you guessed it, inflation. The Fed's already worried about inflation, and now they've got to figure out how Trump's trade policies will play out. Will tariffs cause a one-time price bump, as Waller thinks, or a persistent inflationary spiral, as others fear? Nobody knows, but here's what we do know, the effects are already starting to show. According to the National Retail Federation, prices for consumer electronics rose by 7% in the first half of 2025, thanks to tariffs on Chinese imports. And the American Farm Bureau reports that soybean prices are up 12% year-over-year, as retaliatory tariffs disrupt global supply chains. But wait, boss economist, you say, why haven't we seen more inflation? Great question, my financially savvy friends. According to EY Parthenon's chief economist Gregory Dacko, businesses are playing a game of hot potato with tariff costs. They're front-loading imports, eating into profit margins, and passing some of the burden down the supply chain. But here's the catch, that game can't last forever. Sooner or later, those costs are going to hit consumers like a freight train, and when they do, the Fed's going to have a real problem on its hands. And let's not forget the political pressure. Trump's out here touring the Fed's $2.5 billion renovation project, yes, you heard that right, $2.5 billion to spruce up their marble palace, while railing against Powell. Meanwhile, Treasury Secretary Scott Bessent is calling for a review of the Fed's mission creep. Translation, the politicians want the Fed to do their bidding, not the economies. For my finance pros, this is a textbook case of central bank independence under threat. And for the rest of us? It's a reminder that economics isn't just about numbers, it's about power, politics, and who gets to call the shots. So, what's the takeaway, my economically enlightened audience? Let's zoom out from the clownery and look at the big picture. The Fed's hesitation, the labor market jitters, the tariff chaos, it all points to one thing, uncertainty. And uncertainty, my friends, is the economy's kryptonite. Businesses don't invest, consumers don't spend, and markets get jittery. Just look at the latest numbers. The Conference Board's Consumer Confidence Index fell to 98.7 in July 2025, the lowest in 6 months. And the S&P 500 Volatility Index, or VIX, spiked to 18.5, signaling investor nerves. But here's the real kicker, folks. This isn't just about the Fed or Trump or tariffs. It's about the deeper cracks in the global economy. We're living in a world of slowing growth. Global GDP is projected to grow at just 2.7% in 2025, per the IMF, the weakest in decades. We've got geopolitical tensions, supply chain disruptions, and a climate crisis that's driving up commodity prices. And here in the US, we've got a central bank that's stuck between a rock and a hard place, trying to balance inflation, employment, and political pressure, all while the rest of us are just trying to pay our bills. So, what's the solution, boss economist, you ask? Well, if I were Jerome Powell, and thank the economic gods I'm not, I'd start by being honest. Tell the markets, look, we're worried about the labor market, but we're also worried about inflation. Here's our plan, and here's how we'll adjust if things go south. Transparency builds trust, and trust calms markets. And for the rest of us? Keep an eye on the data, folks. Watch those jobs reports, track those inflation numbers, and maybe, just maybe, start saving a little extra, because if the Fed doesn't get its act together, we might all be in for a bumpy ride. That's all for today, my financially fearless friends. Tune in next time for more economic madness, here on Boss Economics World, where we turn the dismal science into a laugh riot. Until then, keep your wallets close and your skepticism closer. Boss Economist, out.